Millions of Nigerians complain about the increasing Naira exchange rate to the US dollar, currently hovering at around 1,700. Everyone is looking for much lower exchange rates to import cheap products from China and elsewhere. This is really nothing new, especially for keen observers of the Nigerian economy. The Naira has suffered great devaluation for decades, starting from the implementation of IMF Structural Adjustment Program and the liberalization of the foreign exchange market in 1986. Before then, the Naira was stronger than the US dollar at the end of 1985. The question is, why has the Naira continued to fall, starting from 1986 to date? Well, the logic of Naira devaluation is very simple. In a deregulated market, the exchange rate follows the basic economic law of demand and supply. The more we import relative to our exports, the weaker the Naira becomes. Conversely, the more we export relative to our importation, the stronger the Naira becomes. So, frankly speaking, when the central bank tries to manage the value of the Naira using monetary policy instruments such as money supply and interest rates, it's like pouring water into a basket. Such measures will have no lasting impact until and unless the dynamics of US dollar demand and supply is addressed. All the monetary policy gymnastics from 1986 to the present day have failed to reduce the Naira exchange rate, which has essentially gone in only one direction, and that is upwards. By now, it should be clear to all discerning observers that short-term firefighting measures are unlikely to effectively tackle the issue of Naira devaluation. So, the next question is, how then do we strengthen the Naira? Well, if we genuinely wish to strengthen the Naira, and by extension the Nigerian economy, we need to go back to the basics and implement policy measures that increase our foreign exchange inflows and decrease our foreign exchange outflows on a sustainable basis. In this video by Africa Rebound, we highlight 5 of the required policy measures which, when effectively implemented, will help to strengthen the Naira. Spoiler alert, the proposed measures do not include the usual hot money inflows that come as foreign portfolio investments, FPIs. Such funds go after government securities and listed shares on the stock exchange. They are short-term, opportunistic in nature, and leave as fast as they come in. If you're new to this channel, remember to subscribe for more insights of this nature on Africa's economic development issues. Now let's get right into the specific policy measures. Number 1, improve agricultural productivity. Agriculture employs over 36% of Nigeria's labor force, but contributes only 24% to GDP. The sector suffers from neglect and low productivity. The yields for staple crops, such as maize and rice, are less than half of the global averages. Investing in improved seeds, modern farming techniques, and improved irrigation systems can significantly enhance productivity. In 2023, Nigeria imported $2.3 billion worth of food products, yet with investments in irrigation and mechanization, domestic production could meet demand and perhaps open the window to food exports. After all, Brazil, with similar tropical weather conditions as Nigeria, exported food products exceeding $150 billion in 2023. You can imagine what such annual export volumes can do to lower the Naira exchange rate. Number 2, deeper economic diversification. Nigeria is highly dependent on crude oil, which accounts for 90% of its export earnings. This dependency makes the Naira vulnerable to global oil price fluctuations. However, Nigeria has significant potential in agriculture and mining. For instance, in the country's first republic from 1960 to 1966, Nigeria demonstrated great potential in palm oil production. However, Nigeria has all but disappeared from the international palm oil market. On the other hand, countries like Indonesia and Malaysia are smiling to the bank, with annual palm oil exports exceeding $20 billion each. Furthermore, Côte d'Ivoire and Ghana achieved cocoa exports of $3.5 billion and $1.7 billion respectively in 2023, compared to Nigeria's $600 million. There can be no justification for this poor performance. In 2023, Nigeria's agricultural exports were valued at $772 million, a small fraction of the $58 billion earned from total crude oil exports. Going deeper into agriculture, agro-processing, mining, and light manufacturing would enhance foreign exchange inflows and strengthen the Naira. Number 3, promote and support domestic manufacturing. The manufacturing sector's contribution to GDP is 12%, which is significantly lower than other developing countries like South Africa at 22% or Malaysia at 24%. Nigerian manufacturing companies are negatively impacted by the country's infrastructure deficits and unreliable energy supply, thus leading to higher operational costs. Establishing more special economic zones and industrial parks will lower operational costs for manufacturing and increase their competitiveness with imported products. In 2023, China's special economic zones contributed 22% to its GDP, accounting for 45% of foreign direct investment and 60% of exports. A similar strategy can be implemented by Nigeria to boost non-oil exports, reduce Nigeria's reliance on imports, thereby reducing the pressure on the Naira. Number 4. Improve electricity supply. Nigeria's energy deficit severely hampers industrial growth. The country generates about 5,000 megawatts of electricity, which is far below the estimated current energy demand of 15,000 megawatts. Businesses spend an estimated $14 billion annually on diesel generators. By improving energy infrastructure and investing in gas-to-power projects, operational costs for local industries can be reduced, making them more competitive and less dependent on imports. Number 5. Boost tourism and creative industries. Nigeria's creative industry, particularly Nollywood and Afrobeats, has shown enormous potential, contributing $1.4 billion to GDP in 2023. Nollywood is the second largest film industry globally, producing 2,500 movies annually. Therefore, developing the tourism sector and enhancing the global reach of Nigerian music and films can further increase foreign exchange earnings. Well, as you can see, there's no magic wand to reduce the Naira exchange rate. Only sound industrial policies targeted at the real sectors of the economy and consistently implemented over the medium to long term can achieve the desired outcomes. Thanks for watching. If you found this video interesting, don't forget to like and share it. And if you're new to this channel, please subscribe for similar posts relating to Africa's economic development.